This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So last week, we had by far our biggest week of downloads ever. Over 10,000 downloads in a week. Now, for context, in April, we had 10,000 downloads in the month. It's continuously increased after that. But in April, we were ecstatic about having 10,000 downloads in a month. And we had that many downloads in a week last week.
And for real context, when we started this 74 weeks ago, we said if we get 100 people a week, we're thrilled.
Yeah.
But yeah, so Thursday is the day that this drops, is always the busiest day. But last Thursday was 50% higher than any other Thursday.
Right.
It's a big jump.
And the Friday last week was higher than most past Thursdays, which is crazy, like the day 2 after a release. So we're obviously happy that people are listening. But one of the things that made us think about was that there are obviously new people listening to the podcast, which is good, but newer people that haven't gone back to the beginning to listen might not know anything about who we are.
I have no idea who we are.
So we thought it might be worth mentioning that briefly.
Yeah, so we are portfolio managers at a company called PWL Capital. So we are a wealth management firm based in Ottawa. We record this from Ottawa.
In Canada, because I know we have a lot of non-Canadian listeners.
Our team manages a little over $1 billion in client assets, and we solely use low-cost, total market, index type funds to build portfolios.
We say index funds, but in some cases within our team here, we're using traditional index funds, but in most cases, we're using funds from dimensional fund advisors, which we talk about every now and then in the podcast.
Safe to say we do not use this as a overt marketing piece. We do not pitch for clients. I don't think we've ever done that. It's certainly not our intent. Our intent is to give back and to share information.
Yeah. Oh, I wanted to mention too, because I get this question a lot. We manage assets based on a percentage of we charge a fee based on a percentage of the assets that we manage. We don't do fee-only advice. Like we're not going to take, $5,000 to give you advice on your investments and financial plan. There are firms that do that. We don't. So we're what you'd call a full-service wealth management firm. And we do have an investable asset minimum of $1 million. I think it's also important to point out that we don't just give people, like for our clients, we don't just give people advice on their portfolios. I mean, it's kind of like what we talk about in the podcast.
Right.
It's all the stuff.
It's all this stuff.
Retirement planning, insurance, estate planning, tax planning, how to use and think about debt, like how mortgage debt fits into asset allocation, when to take government benefits.
And these come up every day in our world, and we just keep a list going of items that come up to talk about on the podcast, as well as take questions and feedback from listeners.
But that's kind of how the whole thing started. We're thinking about this stuff all the time, and you and I, Cameron, were talking about it all the time, and still are. And we just kind of had this idea that maybe our clients would appreciate it if we did a podcast, because then they would know exactly how we're thinking about all these different issues.
And we're also pretty passionate about following others in the industry, which is where we get all of our guest ideas. And we have amazing guests lined up.
Yeah. But as much as this started as what we thought was a good idea to communicate with our clients, it's turned into a lot more than that, which is awesome. And we found a whole bunch of different benefits from doing the podcast in excess of communicating with our clients that we didn't necessarily expect.
All the unintended consequences, right? I mean, it's such a good thing for our team, for training, for learning. It's made us better, I think, as we've done a ton of research. I mean, we were spending hours every week researching and preparing and thinking about this stuff.
We've had a ton of conversations with people that, would we have ever talked to otherwise? Maybe, but we probably wouldn't have had the same level of conversation with those people. And a lot of those conversations have genuinely, like you talked about annuities, is an obvious example.
They changed us.
Change what we think about.
Conversation with Alexandra changed us for sure. Conversation with Dr. Summers, same thing, it changed us.
And some of those conversations have turned into ongoing business relationships.
Yep.
Which again, like that's a benefit of doing the podcast that we never would have really expected. And like you said, it keeps us pretty sharp because we're doing deep dives into issues every single week that, just like the one we talk about in this episode, is a rental property a good hedge against rising real estate prices?
Great question.
I had to think about that. And if we were doing the podcast, I never would have thought about it.
No.
Unless a client asked, maybe.
I want to give some shout outs and thanks to Mwan or M1 2008 for the kind feedback. Slouchy87. And I'm not sure how you pronounce his name, but it's /, semicolon, open bracket, close bracket.
These are people who have written reviews on iTunes for the podcast. So one of them was
looking forward to listening every week. I'm learning so much. Thank you for producing such an awesome podcast.
Oh, we hired someone. They got in touch with us after listening to the podcast.
True.
Just another benefit. Anyway, I guess the point of all that was to express some gratitude to all of the people who are listening to the podcast and sending in questions and interacting with us and with the content. It makes it worthwhile from all of these different perspectives that we just talked about, many of which we didn't expect.
Got lots of content today. Those questions, some factor funds, insurance, and bad advice of the week. So hope you enjoy.
Go to the episode.
Episode 74.
So you watched a documentary that you were pretty excited about, and I haven't watched it yet, but you want to talk about it?
No, you will love it. I know that for sure. So I follow Mr. Money Mustache, as I think you do, on Twitter, and he announced a new documentary that came out last week, and it's called Playing with Fire. And I just found out as well, there's a comedy that was just released with the same name. So if you search it, it's not the comedy. It's the one about the financial independent, retire early movement. So I guess he was on with Tim Ferriss. I've not heard that interview, I don't think, but he was on with Tim Ferriss 3 years ago. And I believe a movie maker heard that interview and decided to make a movie on the FIRE movement. And I must say, I was blown away by the movie. It's about an hour and 15 minutes long.
So hold on. Is Mr. Money Mustache involved with the movie?
He's not involved with the movie. He's in the movie, but he's not involved, I don't think, in the production of it. He's in the movie for sure.
Okay.
And his group of cohorts that live this way are part of it.
Okay.
So I was expecting a story about how to cut your spending and save more money, kind of your garden variety FIRE is what I was expecting. And it did have that, but it followed this couple as they realized that money is a source of a lot of issues in life. And once they realized that they wanted to have freedom to do the things that they love doing, they realized what they love to do, and they actually showed them talking this through. They realized that what they were doing in terms of their current lifestyle, which is twin luxury vehicles, very high cost of living in California, was not what made them happy. And this was the real breakthrough, because we talked about this in the past, where more income doesn't necessarily make you happier. And they talk at length about how money is the root of so many issues in relationships. And in society today, there's so much pressure from consumerism and how much signaling comes from the stuff you own. And this was a real struggle for this couple, but realizing what made them happy and the drive to get to a point where they could just live that kind of life really motivated them to make some pretty dramatic decisions in terms of where they lived, how much they spent. It was a huge, huge transition that you got to watch through this show.
It gives a whole different meaning to FIRE when you think about it that way, as opposed to thinking about cutting spending as much as possible so that you don't have to work anymore. It's more about spending on what is most important to you, which results in a reduction in spending.
One of the quotes was, "You can't lose if you keep happiness in the forefront." And that was the thing that really triggered with me. It's that it's not so much about being frugal. It's about realizing what makes you happy. And it's a challenge to think about that because we're all so busy. Look how busy you are with the kids, career going kids. Like, it's a busy lifestyle, and you're nowhere, I think, anywhere near kind of the typical consumers that we could all fall prey to. So what's important is the why are you buying this stuff as opposed to just buying the kind of stuff. So another quote they said was, "I can buy this lifestyle or I can buy my life back." And once they realized that they wanted to buy their life back, that's what enabled them to make these changes.
So for these people, what does that mean? What is their life that they got back?
They enjoy things like hiking, spending time with their kids, the simpler things, spending time reading, as opposed to all the trappings of the lifestyle that they did have.
It still sounds like I'd go insane.
Well, they had the same career. They're doing the same work.
So they didn't stop working.
No, they're not at retirement yet, but they got this meter. Beginning of the movie, they show, I forget the number, but years until retirement, whatever it is, 31 years. And they show, well, they make these changes, the meter rolls back, goes down to like 6 years.
Oh.
And they say, well, we really like this part of the lifestyle. So, it goes back up to 12.
That's cool.
They just show the impact of their decisions as they go through life. So they haven't retired yet.
Do they talk about what they would want to do if they were to retire?
Yeah, they go through that. You got to watch it. It's really well done. They talk about how the world would be a better place if we were all rational with our money.
But hold on. Do they like desperately want to get out of their career, or do they love what they do and financial independence is totally separate from retirement?
It's more about having the ability to choose to not to work and to do the things they really love doing.
Interesting.
The quote right at the end of the movie says, "They thought this was a quest about money, but no, it's actually a quest to get more truth out of your life."
That sounds like a way more reasonable approach than thinking about it as retire early.
No, it's about having the ability to spend more time doing the stuff you like doing. So that resonated more with me than the typical way that I've interpreted the FIRE movement.
It reminds me a lot of the discussion we had with the Looney Doctor recently. A similar philosophical approach.
It's on all the platforms, on Amazon. I rented it off Google Play. It was like $4, I think. iTunes has it as well, rental, or you can buy for $10. It's well worth watching. And I know a lot of listeners would really appreciate it.
So this obviously changed your perception of the whole FIRE ideology.
It struck me in a way that I thought about this for a while, which is you got to get straight on what's important to you. So I spent a lot of time thinking about that, and we're quite conscious about that in the office here. And I think it's a better way as opposed to just live frugal just for the sake of living frugally.
After watching that, and you've spent a lot of time thinking about it, I know, because you mentioned this to me a few days ago, are there takeaways that you'll apply to your own life?
Oh, absolutely.
Like what kind of stuff?
Well, this has been going on already, which is perhaps why it spoke to me so much. Once you realize what you really love doing, like I love spending, I did this yesterday, spend a Sunday afternoon just reading. Reading is basically free.
Right.
Hiking is basically free. I love doing that.
Right.
Going to the gym, not expensive. To me, those things are fabulous. Making a good meal at home, that's not like a lot of things I love to do are not expensive.
You know what I started doing recently? Just because you mentioned hiking and exercising. I took my camping pack that I had when I was on the trail on the East Coast, and I had a weighted blanket, probably weighs 35 or 40 pounds, and I stuffed it in there. And then I put my bag that I take to work inside of that. And I've been walking to work with it's probably a 60-pound pack. That's free.
That is free. It's probably good for your core too.
Oh, that feels good.
But once you realize that the expensive stuff, there's a lot of stuff you can do for so cheap. So great film. Highly recommend it. You got to watch it.
Yeah, well, I've got to watch it too.
Okay, some listener questions. Current topic number 2.
I know I've said this before. I don't want to sound like a broken record, but my inbox is often full over the weekend with questions from people that are either listening to the podcast or watching the videos. Like, it's good to get these questions because it keeps the show going. I mean, when's the last time we worried about what we're going to talk about in the podcast? Never, I don't think. Right?
No, there's so much content.
Yeah, but the content is largely, interestingly, listener generated because we get so many good questions that, yeah, there's never a shortage of stuff to talk about. Anyway, so these were the two that stuck out for me recently over the last sort of week. So the first one was, and this is my paraphrasing of the question, is a rental property, so buying a rental property, is that a good hedge against rising real estate prices to ensure affordability of a bigger house later? So you own a house, but you also have some cash.
Yeah, that's the key. You have to have the cash, obviously, for the down payment.
Right. So you own a house, you have some cash, but you're not quite ready to go buy the bigger house that you foresee wanting, say, in the next 5 or 10 years. So instead of leaving that cash in a high interest savings account or whatever, you go and buy a rental property to park the cash.
And you're ignoring transaction costs on this?
No. Well, in my little example that I did, I ignored transaction costs, but you can't. That's a big part of it.
It's a huge part.
The real question is that a good hedge? So you've got, say, $100,000 set aside that you know you want to put toward a house in the future, but not yet. So is it a good idea to put that into a rental property to hedge against, real estate prices going up 20% and then you can't afford the bigger house anymore?
And presumably the other direction is also true.
That's the major downside.
Well, it's also, yes, but housing market goes down, so would your rental property. So you've bought an asset that's got some correlation.
So that's the idea, is you want to buy, and I think that's where the listener question came from, is like, instead of having this cash that's uncorrelated with real estate prices, does it make sense to park the cash in an asset that's directly correlated with real estate prices?
So the question is, does leverage help or hinder this?
When I started thinking about it, and I had to think about it for a couple of days, but when I'm having trouble thinking about something, I always model it in Excel. Like, what do the numbers actually look like?
Do you see what listener questions did to him?
So I put this in Excel, and once I did that, it was obvious that, yes, you get correlation on the asset, but because you're using leverage, like if we're saying that you've got $100,000 that you're going to put into a rental property, so you buy a $500,000 property, you're using 5x leverage. So yes, it's a correlated asset, but your equity, which is obviously what you own, is correlated, but you've got a 5x dispersion.
Magnifier.
Right. So when real estate prices change by 1%, your equity, your net asset, changes by 5%, which, I mean, great on the upside.
But it's going to swamp your correlation with the prices, though. As it goes up, you're going to make so much more because of your 5x.
The correlation is still the same. If they both go up at the same time.
The magnitude of that,
that's the dispersion.
The magnification is going to swamp the benefit of the correlation.
Correct. And this made me think actually of, and this is a total digression, but when we're talking about portfolios, like stock and bond portfolios or whatever asset portfolios, people often talk about wanting uncorrelated assets. And so people talk about that with global diversification, like global equity markets are more correlated now, so there's less of a benefit to diversifying. But that's not true. Even if you have high correlation, but also wide dispersion. So if things move up and down together, but at different magnitudes, there's still a diversification benefit. And this we're kind of talking about from the reverse perspective, where you get the correlation, good, but you also get this big wide dispersion.
Because of the leverage.
Because of the leverage. So if you're putting cash into a property, no leverage, that's a pretty good hedge, but then you'd have all the cash, obviously, and you would just buy the bigger house. So anyway, in short, buying real estate to hedge against real estate makes sense. Buying real estate with leverage to hedge against real estate price changes, I don't think that does make sense because of the amplification from the leverage. Do you agree?
I agree. Question number 2. I've adopted index investing except for my Canadian bank stocks. Can these banks make money in good times and bad? And haven't they had a track record worth hanging on to?
Yeah. We've had this question. I don't know if we've talked about it on the podcast before, but we've definitely gotten the question.
Not as much lately, but boy, over the years, that question comes up all the time.
I mean, the banks, they have done extremely well.
Mm-hmm.
And they are good businesses. But I think one of the challenges when we're looking at a stock or a sector, the specific risk, which is a random risk, it shows up, obviously just from survivorship, it shows up as a positive. Like we know the banks have done well. We know that. But that doesn't make them good investments. They've been good investments in the past. But
Plus,
I think
if they are this great and this persistent in making money, who doesn't know that? Therefore, why would you have higher expected returns from them?
That's right. In thinking about this question, there were two things that I thought were important to consider. One is where do stock returns come from, which relates to what you were just saying, Cameron. And then the other one is how does specific risk affect your outcome? Like you just said, everybody knows the banks are great businesses. That's already priced in. So when you buy a bank stock today, you're buying expected future profits discounted at some rate that reflects their riskiness. And that discount rate is what drives your returns. The fact that the bank is a great business, that's already in there. That's already in the price.
Which will drive down the discount rate.
So you're buying those great future profits at some discount rate. If you receive the profits as expected, your return is having bought those future cash flows at a discount. It's not free. You don't get to buy higher returns with the information that we know today, unless it ends up happening that the banks surprise the market on earnings, which they've done in the past. But whether or not they're going to continue doing that in the future is a big unknown. Yeah.
So you're basically making a focused bet on a single sector that something random to the upside will happen in order to give it a higher expected return.
Yeah. Well, you buy a bank stock today, you'd expect to earn the returns of stocks with similar characteristics. So say it's large cap Canadian value stocks with robust profitability. You'd expect to earn that all else equal. But that doesn't account for the specific risk of the asset, which gives you a totally random outcome. So if you want the returns of that asset class, you have to diversify. If you just try and get the returns of that asset class by buying one company, you're going to get the asset class return plus or minus some random error from the specific risk.
So likely a less reliable outcome.
It's almost certainly a less reliable outcome. And I think that our perception of how reliable the outcome is heavily skewed by how well the banks and how consistently well the banks have done in the past. But that shouldn't form our expectations about the future for an individual company. For all Canadian large cap value stocks with robust profitability, we can have an expectation. For one company, like say RBC, it's really hard to have an expectation.
Good answer. So let's go on to the portfolio topic. And this came from a question that I think you get a fair amount of, right, in your inbox. Questions like, what do you think of this factor ETF? So here's where we do a deep dive into your world of happiness, I would suggest, in terms of how to choose a factor fund. And you're going to you've gone through and looked at a number of different factor funds that are available in the marketplace today.
Yeah. So, I mean, we do get this question a lot. And I know we've talked about this in the podcast in the past about how factor has become this marketing buzzword. And factor can mean a whole bunch of different things. And it's not, regulated or specifically defined. So you can call anything a factor.
Correct.
But I think when we're thinking about factors and we're thinking about investment strategies in general, in order to evaluate them, the first thing that you have to have is a belief about markets. If you don't have a belief about markets, you don't have a framework to evaluate any investment strategy or decision. I think that's step one.
I was thinking about this, like where does that belief, for example, our belief comes from at the basic level that markets are efficient.
Right.
Prices information in. And in that efficiency of information comes a risk story.
Right.
Which leads to our framework of deciding on the different factors. But in reading, for example, this book about Renaissance Technologies, there's a whole different world of belief system in what they do, and they've had mind-blowing returns. And their belief is that There's all kinds of little patterns, little micro patterns that they've been able to capture through systematic use of technology and math. But that's just a whole different belief system, which is quite interesting.
It's a different belief system. It's also an outlier, which makes it challenging in forming your own belief system.
Exactly.
Like you can look at Renaissance Technologies and say, oh, their belief system is pretty good because look at the results. But how do you actually apply that? I mean, you can't. They can, and
they can because they've got
whatever they have.
All these algorithms.
Have you finished that book?
I'm almost done, about 80% done.
Does it talk at all about...
a lot of the framework is similar to what Dimensional talks about, which is it has to make sense. They don't just shove things in for the sake of shoving them in. They obviously don't disclose what they do, but it's always they'll often do 300,000 trades a day, little micro trades, although it's not HFT. It's not queue jumping on trading. It's actually using their information from the patterns and capitalizing on what they see.
Does it talk at all about what they're doing? Just that they're capitalizing on patterns?
And it's math. They're mathematical, brilliant people.
And there's a lot of leverage, I'm assuming.
I don't believe so. It's a good question. Someone can correct me, but I don't believe so. Oh, the returns are staggering.
I know they are.
They're brilliant people.
So you raise a good point. Jim Simons would probably not evaluate an investment strategy the same way that we would, or the same way that Fama would.
Correct.
Because he has a completely different belief system. Anyway.
How do you, sorry to interrupt, but how do you then choose a belief system? Like some people can, to go back to the dividend one, they believe dividends are better. That's your belief system.
Yeah. I mean, I guess
banks are better.
Yeah. I guess it's all about hypothesis testing at the end of the day.
Well, that's where I'm so comfortable with our belief system. It goes back decades of peer-reviewed data.
Yeah. It's built on things that are theoretically true and robust in the empirical data.
All right, let's motor on. Otherwise, this will be a 2-hour podcast.
Well, I mean, it's
super interesting discussion.
I'm glad you brought it up, though. So that does speak to where I was going with this, which is that you have to have a belief system. And when you're evaluating an investment strategy, if you have a belief system, some other strategy that somebody else thinks is smart based on their belief system might look not so smart based on your belief system. Which belief system is better? Like you said, how do you choose one? I don't know.
And what I find so hard is you'll often hear of other things that appear to be very good. Then you put the framework we have, which is all this robust peer-reviewed data, and it's like oil and vinegar that just does not go together. You can't get your head around it.
Sometimes it doesn't. I think in the case of Renaissance Technologies, it doesn't. But in other cases, I think that, well, it doesn't go together. But if one framework can explain what another framework suggests, then if we take the efficient market framework, if there's some other factor model that gives maybe better results or similar results, you could easily say, well, it's just a repackaging of the risk-based factors. Now, they could say the same thing on the other side. Their model's better because of whatever reason that they have. Anyway, so this is why it's important to have a belief system. And choosing a belief system is not exactly easy. But as listeners know, we tend to use the model of market efficiency to make investment decisions. So within that framework, we have the 5-factor model, which is a risk-based framework for how the market prices assets. It's an equilibrium pricing model. For us, if we're evaluating an investment strategy, we're going to use the Fama-French 5-factor model. I think there are other models that will show the quality factor, I think is a great example, where research will show that quality is a good factor that you should use. It looks better in the back-tested data than the Fama-French 5 factors, or than some of them. Like maybe quality on its own looks better than profitability on its own.
Right.
But the question you always have to ask is, do the factors that are already in the 5-factor model, not just profitability, but all of them together, do they explain the differences in returns that are observed through something like quality? And the answer in that case specifically is yes. Like you can use the Fama-French 5-factor model to explain the differences in returns that you would observe using quality to sort securities. And so I think another part of this whole concept of choosing a framework to think about markets is the idea of Occam's razor. Like the simplest solution is probably the best one.
Right.
And so you take quality again as the example. They're using ROE, return on equity, leverage, and debt to book, and earnings variability. There's a whole bunch of different stuff that goes into quality, which makes it harder to calculate, harder to implement, higher turnover in a portfolio that's using quality. And that's something that you could have explained using the factors in the 5-factor model.
Right. The simpler model would have done a good job explaining it.
And on implementation, like when we're talking about actual live portfolios, on implementation, using the Fama-French 5-factor models instead of quality is going to give you a lower turnover portfolio. Because there are less variables, the characteristics of securities will change less often.
So safe to say there's also more product available in the marketplace for investors to choose from?
What do you mean?
instead of using quality as one of the factors, using the other, like mainly size and...
I would say the opposite. There are a ton of quality products out there. Yeah. Well, we're going to talk about some of them.
So let's jump into the products.
Yeah, I think so.
So when you went through the products, you had certain criteria that you used to determine how good they were. So you always took a look at what is the factor exposure in the products.
I want to finish up on quality. There are a couple other things that I didn't touch on that I wanted to. When you take quality, which I mentioned has ROE leverage, debt to book, and earnings variability, if you instead take net income, and this is from Robert Novi Marks, net income instead of return on equity, because return on equity can be affected by one-time expenses. So Novi Marks says you should use net income. And then once you control for the level of profitability, the variability of profitability contains almost no information about future profitability. So that's now negated two things that are in the quality metric. And then for leverage, Fromm and French in 1992 showed that once you control for size, book to market, leverage contains little information about differences in average returns. So it's like all these things that are in quality that make quality sound good can all be explained more efficiently by the 5-factor model. Anyway, I think we already kind of talked about that, but I wanted to make sure I got the points out explicitly.
The points are out. I'm sure listeners are very happy.
Yeah, I hope so. So once we get to thinking about evaluating products, we now have our framework. So we're believing that markets are efficient. We're using the Fromm-French 5-factor model to evaluate products, understanding that pretty well any other factor that's been documented can be explained by the 5-factor model, which maybe supports that as a belief system. But anyway, when I'm looking at products, the easiest thing to do is use US listed funds of US stocks. And the reason for that is the factors for US equity are the most explicit. If you have international equity, some people might treat the definition of international differently. So your factors might not match up exactly with what's in the fund. But for US equity, it's pretty straightforward. And then the reason for US listed is that there's a website called portfoliovisualizer.com that makes this analysis like easier than you could ever imagine. You just put the ticker in and it gives you the full factor regression, but it only works for US listed ETFs. Fortunately, for every Canadian listed ETF that I've gotten questions about, there is a US listed counterpart. Like in many cases, the Canadian version is just a wrapped version of the US ETF. When I'm looking at products, the things that I want to look for are quantitative implementation. So I don't want subjective human active management in there for, I think, what should be obvious reasons. Broad diversification. So I don't want something, like the whole conversation we had with Wes Gray from Alpha Architect.
Right.
Some people might want a highly concentrated portfolio, but that gives you an unreliable outcome. And so when I'm looking at products, I don't want to see that. Low turnover is a big one. It's hard to capture return premiums if your portfolio is churning 50 or 80% every year. Turnover is like how much it changes its holdings each year. So 100% turnover would be it got rid of and bought new holdings for the entire portfolio. Low fees are big. And then consistent factor exposure is another big one. If you're buying a factor fund that's not actually giving you statistically significant factor exposure, obviously you're just paying higher fees for no real good reason.
Let's jump in. So the first one you looked at was the Vanguard US Value Factor ETF, VFVA.
VFVA, yeah.
It's actually a small fund too.
Oh, I didn't look at the assets.
Yeah,
How
like
big is it?
$70 million.
Oh, interesting.
In the US fund and $70 million in the Canadian fund.
So we have, and this is one that I've gotten a lot of questions about, VVL in Canada. So VFVA that's like I said before, the US listed version of the US equity fund. VVL, the one that we have in Canada, is a global value. So one's US, the one that we looked at, VVL is the global value equivalent, but the concepts are all the same. Like the way that they're implementing the products are the same. So they're defining value as book value over price, forward earnings over price, and operating cash flow over price. And you could argue how you should define value, but they're using 3 different metrics. That's fine. It's got 750 holdings, which is pretty good. And you'll see why I say it's pretty good when we start seeing some of the other ones. 70% turnover though.
Super high.
Pretty aggressive. VFVA, the US listed one, has a 13 basis point management fee. VVL in Canada is at 40 basis points for the MER. Now, when we get to factor loading, it's actually pretty good for VFVA, and presumably VVL is quite similar, but it's got pretty strong exposure to the value factor and profitability as well, which is good.
You know there's a but coming.
Well, I
can tell by the way you're talking, there's a but coming.
I really want to like both these funds, VFVA and VVL. The problem, when you read the investment strategy page on the Vanguard website for these funds, they have this, it's like the last paragraph at the very bottom of the page. But it says the fund may take temporary defensive positions that are inconsistent with its normal investment policies and strategies, for instance, by allocating substantial assets to cash equivalent investments or other less volatile instruments in response to adverse or unusual market, economic, political, or other conditions. In doing so, the fund may succeed in avoiding losses, but may otherwise fail to achieve its investment objective.
Death blow.
It's like, come on. It was such a good product.
There's lots of other product.
I don't really understand why they're putting that human subjective overlay on top of what otherwise is a pretty good value product. So anyway, there's one. So VVL would be the Canadian equivalent of the one we just talked about. And I think between YouTube and emails from the podcast, I get a lot of questions about VVL.
You get lots about the next one, the iShares Edge MSCI USA Value Factor ETF, VLUE.
Well, I got one recently.
And XVLU in Canada.
Yeah, so XVLU is the Canadian wrapped version of VLUE.
So the US fund is huge.
I didn't look at the assets. How big is it?
4.5 billion, but the Canadian fund is small, but it's just launched 2 months ago.
Yeah. So they're using book value to price and 12-month forward earnings to price and dividend yield. So again, a bunch of different value metrics, which, it's kind of interesting actually. If it's a single factor product, so if it's not using all 5 factors in the Fama-French model, using these alternative or mixing together different metrics for value actually ends up giving you exposure to other factors. So when you control for size, value, profitability, and investment, adding in alternative metrics for value doesn't give you anything. But if you're only looking at value, adding in the alternative metrics gives you exposure to maybe a bit of momentum, maybe a bit of profitability. Anyway, interesting side note. So XVLU or VLUE is the one I was looking at, 148 holdings. So now it's pretty concentrated. Not 40 stocks like Alpha Architect, but still.
And half the turnover of the last fund, the Vanguard fund, 35%.
For the year ending July 2019, but I looked at the statements, and in 2016, it turned over 81%.
It's wild.
It is wild. And for this fund, you're paying 15 basis points in the US, but 30 basis points for the Canadian listed version. Now, in this case, it has value exposure, pretty good loading to value, but statistically insignificant. Close, 1.5 T-stat, but not significant at the 95% confidence level, which is kind of like if you're buying a value fund, you'd probably want statistically significant value exposure at the 95% confidence level. The big one for me on this is 148 holdings. That's going to give you an unreliable outcome.
The iShares Edge MSCI USA Quality Factor, QUAL, and XQLT in Canada. This is a $14 billion fund in the US, and it's a new fund in Canada.
Yeah, they just launched all these. Was it earlier this year they launched them? Did you look?
Don't remember the date on that one.
Okay. So they're measuring quality as high return on equity, stable year-over-year earnings growth, and low financial leverage.
124 holdings.
41% turnover. And the fees similar to VLUE, 15 basis points in the US, and XQLT in Canada is at 30 basis points. Now in this one, you're seeing pretty good exposure to profitability, which is kind of what you'd expect from a quality fund. So that's fine, I guess. Negative exposure to value, which again, with something that is seeking exposure to quality, which is similar to profitability, you'd expect negative loading to value. It's actually one of the things that's really interesting when you look at the dimensional funds, because they're going deeper on value, you won't see a big regression coefficient for profitability, even though dimensional is targeting profitability. But it's like, if they were just going after value and not looking at profitability at all, you'd expect a negative loading to profitability. But even a small positive loading when you're going deep on value is, I don't know what you call it, impressive. I don't know if impressive is the right word, but all else equal, you'd expect if you go deep on value to have a negative loading to profitability.
Right.
But by looking at both things together, you
can
actually
pull the profitability up.
That's right. So anyway, in this case, because the iShares fund is only looking at quality, you do get negative exposure to value. If it were a multi-factor fund, you might not see that. I know the turnover is high, but again, concentrated. I wouldn't feel comfortable investing or telling someone to invest in a fund that has a couple hundred holdings.
Okay, let's look at a couple of Fidelity funds. Fidelity Quality Factor ETF, the FQAL and the FCUQ in Canada. US fund's about 150 million. The Canadian one is about 100 million.
So for this one, the thing that, it's called a factor fund, right? You're paying 39 basis points to own this thing. And when you look at the regression coefficients, they're all small and statistically insignificant. So it's like, what are you paying 40 basis points for?
So there's no factors loaded.
Not in a way that is statistically significant. Actually, in this one, so it's a quality fund and it's actually got negative loading to everything, including profitability. So in this case, maybe I just don't understand their fund at all. But, well, they said that they're looking for companies with strong balance sheets and more stable cash flows than the broader U.S. equity market. But that
129 holdings, 29% turnover.
Yeah.
But
no factor exposure.
No factor exposure in this quality.
And I think this is the tricky thing about someone calling something a factor fund. It's like, what is under the hood? What shows up in the regression? I think we can jump over. I had a low volatility one that I don't know if we need to talk about.
And then going to Fidelity High Dividend ETF, the FDVV, FCUD in Canada, $450 million fund in the US, $127 million in Canada. Definition of factor is high quality US dividend paying companies.
So I thought that was interesting. Like you're taking quality and then overlaying a screen for dividends, which, as everyone knows.
Yeah, don't start on the dividends. Okay, so what was the factor loading on this like?
I mean, nothing crazy. It had you know what? Actually, it is interesting when you think about it. So it had a pretty strong and statistically significant loading to the investment factor. So that's companies that invest conservatively. And if a company is investing conservatively, you would expect it to be paying a higher dividend. So it kind of makes sense that they backed out exposure to the investment factor. But I don't know if that's a good thing, especially when we're talking about, these are probably, I didn't look, but they're probably SMB 0. So it's about market cap. I was going to say it was probably larger companies, but it has market cap weighting of size.
No value loading.
Tiny bit of value, yeah. Nothing economically or statistically meaningful. But the investment exposure is interesting because theoretically that matters, but empirically investment is really tricky to pin down. Like Dimensional, they've known about it for a long time. They've only recently started looking at implementing it in portfolios. And the reason is differences in investment are not predictive for larger companies, but for smaller companies with weak profitability that invest conservatively, it does explain differences in returns. But I think that using investment as a filter in a fund like this, when we're talking about total market and not just looking at small cap growth companies, I don't know how meaningful the investment factor is going to be.
Okay, so the main takeaway to me of all of this is there's more to an ETF or a fund than the name might reveal. Having this framework of the factor loading makes a lot of sense. You want to watch for turnover and you want to watch the number of holdings to increase your reliability. That's kind of the main takeaways that I think people should...
Yeah, and I mean, you really have to read. You can't just look at the title and say, oh, it's a factor fund, good. Like VVL, I think, is the biggest example where it is an actively managed fund.
But even if you read it, you still wouldn't know what the factor loading is unless you went and use that site you mentioned.
Yeah, you can use portfoliovisualizer.com, but that's one piece of it. It's also, what is the strategy of the fund? Like, what are they actually doing on implementation? That's the one that blows my mind for Vanguard, is that it's a value factor ETF. Great. But then you read the actual investment strategy page and it's an actively managed fund. It's like, what? What happened?
I want factors.
Yeah, but that's the thing.
Consistent exposure to the factors.
So people hear us talk about factors, so they go and Google factor ETF and great, a global value factor ETF, and it's pretty cheap.
Yep.
But it's an actively managed fund.
Okay, on to the next topic.
Yep.
Okay, so the planning topic this week is going back to our discussion 2 weeks ago about life insurance. How much life insurance do you actually need? Because we made a comment about a study that showed that most people don't have anywhere near the amount of life insurance they should have in place. So I think you had a question, well, how much should I get?
Right.
So we thought we'd help kind of frame that discussion, that decision about how much insurance you should get. And so today we're talking about insurance from a risk management standpoint. There may be reasons why you want some sort of permanent insurance. It might be estate planning reasons or tax reasons. But today we're talking about basically income replacement.
On what you were saying there, I'm getting more and more interested over time in the concept of using permanent insurance in asset allocation as part of the fixed income component for tax reasons. We can come back to that in a future episode.
Another episode, I agree. But today we're talking about income replacement, risk management for your family, and how do you decide how much insurance to get.
Right. So it's going to be term insurance.
It will be term insurance.
The amount of times that I've seen people with this type of need, an income replacement need, who have a permanent policy, it's like, man.
Especially when term insurance is so cheap, it's so affordable if you're young and healthy. So basically, if something happened to you, you pass away, you want to make sure your family is taken care of to the lifestyle that the surviving family would want. So the amount of insurance, I believe, on you is actually up to your wife, not you, because she's the one in your situation that's left behind to take care of things.
Yeah.
I mean, a lot of people make kind of glib jokes, he'll be fine or she'll be fine. No, it's not up to you to make that judgment call. It's up to them to make that call.
Yeah. And so I think in thinking about preparing for talking about this, I split it up into 2 different possible buckets where you and your spouse can decide to either plan to maintain current lifestyle, which has implications in the amount of insurance that you would need, or you can plan to change lifestyle on death of a spouse.
And I've even seen some people say, look, I would presume within, say, 5 years or 10 years, you'll meet someone else and carry on in the next chapter of your life.
Right.
That's a rational decision. Some people want a fully funded retirement. Some people want to pay off all the debts. So it's a very personal decision.
Yeah. So I think at the bare minimum, and this is just maintaining lifestyle, but I agree, it's all a very personal decision. But if we just say the bare minimum is to maintain lifestyle. You want to be able to replace the amount of your income that is currently going toward household expenses and savings.
For a certain amount of time, and it could be for life, and then it becomes a discounted cash flow calculation.
Right.
The present value of that.
So if you take a household that has, say, equal incomes, both spouses working, maybe the child in daycare, and total expenses are $10,000 per month between the family as a whole, or across the family as a whole. And so each spouse is covering an equal 50%. So if one spouse dies, you need to be able to replace the $5,000 per month for, like you said, some specified period of time. And that might be until the kids are independent. Maybe. It might be until you expect to reach financial independence. That's the other thing about life insurance planning is like all of it is built on top of an overall financial plan.
Has to be. There's far too many rules of thumb as well, like was mentioned in that study. You may end up with a rule of thumb, but there's so many different phases. Like, let's say you're young now, you don't have kids. There's that phase between now and you might have kids. Then the 20 years when you do have kids at home, or 25 years. Then there's the phase post-children. And again, it's up to the surviving spouse to decide how much protection they want for each of those time periods.
Yeah. And I probably would include, like when we're talking about replacing whatever amount of income, I would include whatever amount was going into savings. So say if we're saying one spouse is covering $5,000 of household expenses, but $1,000 of that is going into retirement savings, you got to replace that too. Otherwise, the whole financial plan gets thrown off. Like, why are we doing life insurance? To ensure the financial plan, to make sure that things work out on death.
And you could also choose to have it pay off the mortgage, which is often the case. Therefore, it reduces the amount of cash flow you need to maintain your lifestyle.
I think that's a sensible way to think about it. Like, instead of including the mortgage payment in the $5,000 cash flow figure, I would eliminate the mortgage payment and have enough insurance to pay off the mortgage in full.
And this is also why we believe you should do your insurance planning as part of your financial plan and not part of the mortgage application, and not have the insurance coverage as a tick box when you apply for your mortgage at the bank.
Yeah, I mean, there are a lot of reasons for that, like when they underwrite and how they underwrite.
In the banding of fees, but
Separate discussion.
If, for example, you want to replace $5,000 a month for 20 years, so you're half of the household expenses, discounted by 2%, that's $980,000.
And 2%, that's a real 2%. So that's
Correct.
$5,000 adjusted for inflation.
Right.
So if we're assuming 2% inflation, that's a 4% expected return, which I think is pretty conservative.
Yeah, so that's for 20 years. You might decide when it comes time to choose the policy to have part of that in a term 10 policy and part in term 20. So you lock in the second 10-year term rates.
Right.
You might let the term 10 drop after 10 years.
And why wouldn't you do all T20? Because it's roughly twice as expensive.
Yeah, you're paying more for the first part of the first 10-year period.
But again, we come back to this concept of the insurance has to tie in with the overall financial plan, because you have to know that 10 years from now, whatever portion you're going to do as T20 is going to be sufficient.
Yeah.
But you wouldn't know that unless you had some sense of what the overall financial plan looks like. Did you say the amount?
Yeah, $980,000. You round it up to $1 million. The cost is irrelevant, frankly. There's going to be all kinds of upfront expenses. You may bring family to town. They may have a donation you want to make on death.
Yeah.
So you may want to donate to a university or something, your alma mater.
Start an endowment kind of thing?
I've seen people set up endowments in the past. They want to donate, say, $250,000 to be able to pay out a certain amount of money per year for...
Would you do that with a term policy? I would think about that as a permanent planning.
You can do it as a permanent for sure. But I'm saying just as you go down the list of what you need money for, because I've had a number of situations where this has happened, unfortunately, with clients. And I can tell you, the money flies when this happens.
Oh, yeah. I can imagine.
Just when there's the funeral, and I don't mean to be creepy about this, but there's a funeral, there's bringing family to town, there's setting up the endowment, there's all these different things that you do right out of the gate. I tell people, let's get the number and then round up. It doesn't cost a lot to round up.
It doesn't cost a lot. When we do this, like when we're sitting down with clients doing this, as we continuously allude to when we're talking here, it all stems from the plan. So we figure out what does the overall financial plan look like in terms of savings and expected retirement date and even asset allocation and things like that. And then we work backwards from that to figure out if someone died today, how much life insurance would you need? And then we use Monte Carlo simulation to make sure that the result is robust. Most people don't have that, but I think just like the little calculation that you mentioned, using a really conservative discount rate to find the present value of those future liabilities, that's an easy way to approach it. And I guess if you're sitting down buying insurance, the agent should have some method to calculate the amount.
Oh yeah, there's all kinds of tools online as well. The reality is though, you meet so many people that will say, I got a work policy, it's a couple $100,000, we'll be fine. It's like, that's not going to do anything to replace any income.
Yeah. The other big decision that we haven't talked about yet in calculating the need is if a spouse dies, the surviving spouse, maybe they don't want to keep working.
Right.
because they're devastated and maybe they're worried about the kids. So that's a whole other aspect of the planning where, and it's like you said, it's talking to the spouse. If I died, my wife doesn't work, but if she were working, if I died,
wife works very hard.
she doesn't have work outside the home.
I'm not trying to set you up, but
you're going to get me in trouble.
Your wife's a trooper.
She works very hard.
But it's a good example though. So something happened to her.
Yeah.
A lot of people say, I'll just keep on working. Yes, but it will cost something to replace what your wife does do.
Yeah. Oh,
You'll need a lot of home care for sure.
Oh, yeah. Yeah. But then that's the same, like, would I want to continue working? I probably would because I really like working, but who knows?
Might be halftime.
And if I didn't want to do that, that is something that we would need to plan for in the amount of insurance that we're going to buy for my wife. Like maybe it's not just enough for childcare. Maybe it's enough for childcare and for me to take significant time off. So that all goes into the calculation.
Anything else to add to that?
You know, one of the things that I was thinking about on the topic of life insurance is how it relates to asset mix. It's more about how do you treat your existing assets when you're figuring out how much life insurance coverage that you need. And so the way that I was thinking about it is that if you say you decided that you need $1 million of coverage, but you've got $500,000 in investments, do you exclude the portfolio or do you include the portfolio as part of the insurance calculation? So if you have $500,000 in a portfolio, maybe you decide you only need $500,000 of coverage. You need $1 million to fund.
But the portfolio presumably is for the long-term retirement.
So this is where it gets tricky, is that if we assume that the $500,000 portfolio reduces your insurance need, but the portfolio is aggressively invested in like 100% equities, can you really count on that to be there?
In 30 years, yes.
In 30 years, yeah, but if you died tomorrow.
But I'm talking about for the surviving spouse though.
Right. But if we're saying that you need $1 million of liquidity to fund lifestyle today on death.
Right.
And there's $500,000 in a portfolio invested 100% in stocks. Do you buy enough insurance to cover the full $1 million liquidity need, or do you rely partially on the portfolio?
Well, I'm assuming the portfolio is there for long-term needs, not for short-term needs.
But it fits
in. You have to make sure your portfolio is lined up to what the time frame is for the needs.
You would ignore the portfolio.
I think so in most situations.
But it's tricky, right? Because the closer you are to financial independence, the more of your human capital is in your financial capital.
Which means the less insurance you do need, though.
I know, that's what I'm saying.
As you get older.
Right, so the portfolio does interact with the amount of insurance. But my question is, how does it interact? Is it one for one?
Unless you're talking about buying market collapse at time of death insurance?
No, I'm just talking about planning for, assuming that you might not have the full amount of your existing investments at the time of death when you're figuring out how much life insurance you need. You would have
considered that in your Monte Carlo analysis anyways as part of your plan.
We would have. But if someone's thinking about how much insurance they need on their own, I'm just thinking if you have existing assets that are invested aggressively, it might make sense to discount them when you're figuring out how much insurance you need.
Interesting. Hadn't thought of that. And frankly, for most people to buy more term, it's so cheap. Just buy more. Literally, it's so cheap.
It is. Yeah. It is not expensive. Oh yeah. When I was thinking about this exact thing, I looked at if you include the $500,000 of portfolio in the insurance calculation, meaning you only buy $500,000, and I compared that to if you discounted it to 50% of its value, assuming the market tanks at the time of death. So you're buying $750. The difference in cost was $20 a month.
There you go. On to bad advice of the week.
Yep.
So this one, I got permission from a client to share this story. I'll generalize it so it's not too specific, but it's a good example, and I appreciate him allowing me to share this story. He's a regular listener. So client was in, his mom, who is in her 80s, has a portfolio and is living off this portfolio, but there's not enough money in the portfolio to last as long as she's expected to live. So she's in her 80s, and her mom lived to 104. So he just asked us for some feedback on the situation. So the portfolio was full of mainly equity, mainly active, all active equity mutual funds.
Wow.
In her 80s. So that was now it had done well. So knock on wood, it turned out okay. So he decided, okay, well, she wants to stay at the bank. She's with 2 banks right now. I'm going to go visit them and try to clean up the portfolio and, get a broader portfolio, better asset allocation, and lower the fees. So that was his mission, to go and help her. So went to bank number 1, and to the bank's credit, they had been wanting to talk to them to reduce the risk of the portfolio, which is admirable. So when the son asked about lower fee options such as ETFs or index funds, he said the branch representative was not at all interested in discussing index funds.
Not interested. Like, just said, no, I'm not interested in talking about it?
They said they could add in a bond index fund and have 3 other active equity funds. So in the end, he said they were very nice. To their credit, they were very nice, and they decided on some sort of 30-70, so 30 stock, 70 bond portfolio. So it's a much more sensible asset allocation, and the fees came out at 1.47%, which is much lower than the average fees. You could have gone cheaper with ETFs, but still it's better than it was and more suitable than it was. He then went to the other bank, and when he framed it the same way, which is one of the lower fee options, ETFs indexing, they basically said, well, you better set up an account online and go, and I quote, buy your ETFs. But why would you do that, they said, when the funds you have done so well?
Good question.
So anyway, so I had a good chat with him. He called to see if we could help him out in what they should do. And given our recent conversations, like the one on reverse mortgage, because she's still in her home, and annuities, I said the biggest risk here is that she lives risk. Let's hope she lives as long as her mom did, to 104. The money she has now will last another 7 years. So won't even make it to her age 90. There's another potentially 14 years after that. So we actually worked through some of the math that we talked about a few weeks ago on reverse mortgage. And for now, they're not going to do that because they don't need a lot of money to make up the shortfall. But they can take the money she has now, buy an annuity that will make up roughly 2/3 of her shortfall. So
Wow.
she's short 1/3. She has lots of equity in her house. So she could easily go get a simple line of credit now at prime plus 1 or something, which is a little bit lower than the reverse mortgage rate.
But she couldn't get a line of credit, could she?
She actually has one now. She has a secured line of credit right now. So she could. There's a risk of it being called, at which point I said, at that point, you look at a reverse mortgage.
Right.
But these kinds of planning discussions didn't happen at the two banks. It was basically nicely said, like, we can't really help you with what you wanted to do, but what should have happened is what we ended up talking about. So they're super happy. He was super happy with the discussion. But it's interesting how, our recent research and work on reverse mortgages and annuities has helped a lot.
That is interesting.
So again, thanks for the input, and I appreciate it very much. Anything else on your mind?
Nope, I think I'm good.
Good. Well, thanks for listening, and we'll see you next week.